Welcome back to Bitcoin Deep Dives by MyCryptoParadise. I'm really excited for today's deep dive because, well, the stakes are just astronomical right now.
Oh, they absolutely are. It's getting wild out there.
Yeah, wild is an understatement. Just look at the numbers. MicroStrategy is currently sitting on roughly $7 billion in unrealized losses.
7 billion with a B.
Right. And then you have BlackRock, right? The absolute titan of institutional money. They just offloaded almost $90 million worth of Bitcoin and I think another $30 million in Ethereum.
Yeah, that's accurate. The biggest players in this space are bleeding right now.
Exactly. So the massive question hanging over the entire market right now is, will these mega players get shaken out? Especially as Bitcoin faces this very real, mathematically probable crash down to the $44,000 mark.
Well, when you see numbers with that many zeros attached to them moving in the wrong direction, panic is the natural human response.
Yeah, oh, for sure.
But, we aren't here today to just gawk at the carnage. On this deep dive, we're looking inward. We are analyzing a recent, really intensive market update from the Paradise team's own lead trader, Simon.
And Simon's insights are always, they just cut right through the noise.
They do. And yes, we're definitely going to cover his specific price targets like that 44K downside and the macro $169,000 upside. But our real mission today is unpacking something much deeper.
The psychology of it all.
Exactly. The behavioral science of trading. We're exploring Simon's professional mindset versus the gambler's mentality that, frankly, bankrupts so many retail investors.
Right, because what makes the MyCryptoParadise strategy effective isn't just, drawing arbitrary lines on a chart.
No, not at all.
It's this ironclad emotional discipline. It's about how you survive when the market stops acting like a chart and turns into an active hunting creditor.
A predator, yes, that's the perfect word for it.
And to understand why a violent crash to $44,000 is likely on the horizon, we first have to look at the underlying mechanics, like who is physically being forced to sell.
Yeah, Simon calls this the exchange of hands.
The exchange of hands. Walk us through that.
Sure. So this isn't a new phenomenon. We saw this exact same mechanism play out in 2016, in 2019, and again in 2023.
Right. The cycle repeats.
Always. To create a true macro bottom in a bear market, there fundamentally has to be an exchange of hands. The weak hands, meaning the entities holding the asset who simply cannot survive the financial pressure of a prolonged downturn, they have to fold. They fold, and the smart money steps in to buy.
Okay, I actually want to push back on that term, weak hands, for a second.
Oh, how so?
Because I feel like the internet narrative has completely warped what that means. You spend like 5 minutes on social media during a crypto downturn, and all you see is diamond hands this, diamond hands that.
Oh, the memes, yeah.
Right. There's this toxic idea that if you're just brave enough, if you just hold forever no matter what, you'll win. But weak hands aren't always just scared retail traders trading in their basement.
Not at all. Often they are massive operations facing brutal financial realities.
Exactly. Simon gave this really visceral example with smaller Bitcoin miners in his update.
Yeah, the miners.
Right. These are bad traders. They're businesses.
Yeah.
You have an ongoing global energy crisis, making electricity incredibly expensive, paired with falling Bitcoin prices.
The margins just vanish.
Exactly. If you run a smaller mining farm, the math just stops working. You literally cannot pay your utility bills to keep the servers running. So to physically not end up living under a bridge, they're forced to liquidate their crypto reserves.
They sell the machines, they dump the Bitcoin at a massive loss just to keep the lights on.
Yeah. Holding a volatile asset during a liquidity crunch is it's like holding your breath underwater.
That's a great way to put it.
It's easy for the first 10 seconds, right? You feel fine. But when the electricity bills come due, when the broader economy squeezes your cash flow, those are the equivalent of burning lungs. Everyone has a breaking point where your body just forces you to inhale.
Right. And that forced inhaling, that forced selling creates a cascading pressure on the price. Think about the mechanics of what happens when those miners dump.
A flood of supply.
Exactly. That sudden influx hits the market, driving the price down further, which then puts pressure on the next rung up the ladder, the corporate whales.
Which brings us back to MicroStrategy.
Precisely. Even the biggest players aren't immune to the mechanics of a liquidation zone. Using Bitcoin as a treasury reserve makes sense on a macro timeline, sure, but holding through a massive drawn-out distribution period is absolute agony.
Because they have shareholders.
Shareholders, operational costs, debt obligations. If the price stays low long enough, even giants might be forced to capitulate.
So if literally everyone has a breaking point, How does the Paradise team actually predict when those breaking points will hit the market? Because, I mean, Simon isn't just guessing out there.
Oh, absolutely not. He uses technical frameworks that are grounded in natural rhythms. Specifically, he relies heavily on Elliott wave theory.
Okay, for the listener who maybe isn't charting every day, what does that look like?
So Elliott wave theory visualizes the market as a breathing organism. Instead of just chaotic green and red candles, the market moves in specific 5-wave patterns.
Like inhaling and exhaling.
Exactly. You have the inhaling phases. These are the motive waves pushing the trend forward. And then you have the exhaling phases, which are the corrective waves pulling it back.
Okay, so where are we right now in that breathing cycle?
From a macro daily time frame, Simon's analysis shows we are basically finishing a massive exhale. We are at the very end of the 4th wave in the sequence.
Got it.
And once that exhale is fully expelled, the market is preparing for a final, violent 5th wave drop down to that $44,000 major support level.
But how do we know the exhale is almost finished? I mean, how do we know we aren't just going to keep drifting?
Well, Simon backed this up by looking at momentum. He pointed out a glaring bearish divergence on the MACD histogram.
Okay, let's break that down. For anyone who glazes over at acronyms, MACD is it essentially compares a short-term moving average of price against a long-term moving average.
Right.
It tells you if a trend is accelerating or running out of steam. It's basically the market's speedometer.
That's a perfect analogy. And Simon used another analogy about fuel and gravity that really illustrates what that speedometer is showing us right now.
Oh, the car on the hill.
Yeah. Imagine you're driving a car up an incredibly steep hill. You need a constant supply of fuel to keep pushing upward. But if you start losing fuel, which on a chart is your MACD momentum dropping, the car might still coast upward for a few seconds.
Just off sheer inertia.
Right, exactly. The price might inch a little higher, but eventually the fuel runs out and gravity takes over, and it pulls you violently back down.
Okay, so let me play devil's advocate here for a second.
Sure, go for it.
If Simon is looking at the fuel gauge and seeing it hit empty, and he's projecting a highly mathematically probable drop to 44K, why doesn't the Paradise team just aggressively short the market right now? Like, why wait?
Because gravity doesn't always take over instantly.
Uh-huh.
The period between running out of fuel and the actual crash is a sideways consolidation phase. It's what we call the chop. And that chop is where the real damage happens to traders.
It just grinds you down.
Yeah. If you short the market too early, you get absolutely destroyed by random volatility spikes before the real drop even begins.
Which actually builds perfectly on that car analogy.
Mm-hmm.
If you're a driver and you feel your engine start to sputter on a steep hill, a gambler just stomps on the gas pedal.
Yep, hoping for a miracle.
Right. They max out their leverage, hoping the car magically finds grip, or they aggressively slam it into reverse, trying to short it immediately. But a professional pulls the handbrake.
Hey, pause.
They reassess the terrain.
Yeah.
And Simon is essentially telling the entire MyCryptoParadise community to pull the handbrake right now.
And we see that tactical response in how the Paradise team manages their assets. They distributed their holdings into hard wallets, moving between Bitcoin, USDT, and gold during previous market peaks at $19,000 and $121,000.
So they secured their capital when the car was still at the top of the hill.
Exactly. And Simon is absolutely adamant about this. He refuses to reaccumulate aggressively until the market hits that $55,000 to $44,000 zone, or until he sees a fully confirmed, mathematically proven bullish structure.
Which means sitting on your hands for a long time.
A very long time.
And that leads to a whole new problem, honestly. Surviving the agonizing chop of a consolidating market requires overcoming some deeply ingrained human biases. Because while we're sitting on the sidelines, the market isn't just resting.
No, it's hunting.
Right. Simon describes the market during this phase not as a passive environment, but as an active predator.
This is where we get into the actual mechanics of market manipulation. You have to remember, the market is largely controlled by a minority of entities holding the majority of the money.
Market makers, massive institutions.
Right. And what does a predator do? It hunts where the herds gather.
And right now, the herd is gathered at the $69,000 to $70,000 level.
Exactly. Simon's analysis points to a massive cluster of retail stop losses sitting right above that resistance level.
Let's explain why that matters mechanically for the listener. A stop loss is an automatic order to sell your asset if the price moves against you. Retail traders place them just above resistance levels if they're shorting as a safety net.
Right.
But when a market maker sees millions of dollars in stop loss orders clustered in one obvious place, That's not a safety net. That's a buffet.
Precisely. It's free liquidity. The market makers have enough capital to artificially pump the price just high enough to hit those stop losses.
And then what happens?
Well, when a short seller's stop loss is triggered, it forces an automatic market buy order to cover the position. All those forced buys suddenly spike the price even higher, which triggers the next guy's stop loss and the next guy's.
Wow, so it's a cascading liquidation event.
Exactly. The predator market surges up, wipes out the herd, grabs all that liquidity, and then immediately resumes its crash downward to the 44,000 mark.
And trying to trade through that manipulation will just ruin you.
Mm-hmm.
Simon actually shared a cautionary story in the update about a friend of his to highlight exactly this. The guy was a quote-unquote breakout trader.
Right. Now, to be fair, a breakout strategy can be really lucrative during a strong trending market. You wait for the price to break a key level and you ride the clear momentum.
Yeah, this friend did very well when the market was actually trending.
But then the environment changed. The market entered this massive fourth wave consolidation. It started moving sideways in a volatile, choppy range.
And this is where the mechanics of whipsawing come into play. When the market is moving sideways, it constantly fakes a breakout.
Over and over.
Yeah, it crosses a resistance line, so the breakout trader buys in. Then, the predator market immediately reverses course. The price drops, hitting the trader's stop loss, so they sell at a 5% loss.
Brutal.
Right. But then, an hour later, the market drops below support, so the trader shorts it. It immediately reverses, pumps back up, and hits their stop loss again. Another 5% loss.
They are just getting whipped back and forth, bleeding capital with every fake move.
And Simon's friend just kept using the exact same strategy despite getting whipsawed. He got liquidated 3 separate times, he lost everything he had made, and things got so desperate he actually went to a traditional bank to borrow money to keep trading.
Which is just, it's heartbreaking. Simon even offered him a free seat in the Paradise VIP group to learn how professionals actually adapt their strategies, and the friend refused.
Yeah, he claimed he was just trading, quote, for fun.
Ugh. That phrase.
That phrase alone is a massive red flag. It's the ultimate defense mechanism of a gambler who is losing. By saying it's just for fun, you absolve yourself of the responsibility of treating your capital with respect.
Exactly.
It's like trying to use a snowplow in a sandbox.
Oh, I like that.
Think about it. During the winter, in a specific environment, that snowplow is the absolute best tool in the world.
Yeah.
You feel invincible pushing the snow. But the seasons change. The market consolidated into a sandbox.
Right.
And instead of stepping out of the snowplow and picking up a shovel, this guy just kept slamming the gas pedal, trying to force the plow through the sand. It's the completely wrong tool for the environment. If you force it just because it worked yesterday, you aren't just going to get stuck. You're going to permanently ruin the machine.
That adaptability, knowing when the environment has changed and it's time to step out of the snowplow, is really the core ethos of MyCryptoParadise. To avoid the fate of that retail gambler, you have to adopt the psychological armor of a professional.
You have to shift from the mindset of a casino patron to a professional poker player.
Exactly, and let's explore that difference. How does a professional poker player approach the market differently than a guy pulling a slot machine lever?
Well, a professional poker player, much like the Paradise team, does not care about the outcome of a single individual hand.
Right, it's just one data point.
Yeah, if they lose one hand, they don't revenge trade. They don't attach their ego to it. They only care about probability and risk management over a long series of events.
Simon explicitly states in his update that professional trading is simply working with probabilities, but executing that requires a level of emotional discipline that the average person naturally lacks.
Because the market is constantly testing you. You have a small position, the market randomly pumps 5%, and suddenly greed floods your brain. You feel FOMO.
You think, oh man, I should have leveraged 100 times more.
Exactly. Or the market chops sideways and panic sets in. Simon insists that the only way to survive these emotional tests isn't just to clench your jaw and try really hard in the moment.
No, willpower isn't enough.
You literally have to change your lifestyle.
Yeah.
You have to build a baseline of emotional stability in your daily life. Good sleep, routine, detachment, so you are psychologically armored against the warfare of the charts.
Which brings us to a really interesting concept from the update. Smart whales versus dumb whales.
Oh, yeah. Just because an entity has millions of dollars does not make them smart.
Not at all. Old money makes incredibly stupid, emotional decisions too. That's why the Paradise team isn't just blindly following large wallet movements on the blockchain. They wait to see the smart whales stepping in.
Let's explain the mechanics of how a smart whale actually operates when they step in, because they don't just, log on to an exchange and hit market buy.
Right. When we talk about whales absorbing selling pressure, we're talking about massive buy walls.
Buy walls.
Yes. A smart whale will look at that $44,000 level, realize it's a macro bottom, and they will place enormous limit buy orders slightly below the current price.
So they essentially build a brick wall in the order book.
Exactly. So when the weak hands panic and start market selling their Bitcoin, they are selling it directly into the smart whale's limit orders. The whale absorbs all that cascading panic without pushing the price up, accumulating thousands of Bitcoin at the absolute lowest risk point.
They act as the floor.
Yes.
And to maintain the mental clarity required to execute that kind of patience, to avoid becoming a dumb whale who just buys the top out of FOMO, you need a serious psychological anchor.
You really do.
At the end of Simon's analysis, he actually shared his own emotional affirmations. Things like, I am thinking probabilities, not emotions. Losses are feedback that sharpen my strategy. I detach from outcomes.
It's powerful stuff.
Hearing a top-tier trader recite these isn't just motivational fluff. It reinforces the whole methodology. They aren't selling a get-rich-quick dream. They rely on clinical psychological mastery.
And we have to look at why those affirmations are a mandatory part of the system. Why is this so hard for people?
Why do so many fail?
The truth is, the human brain is literally hardwired by evolutionary biology to fail at crypto trading.
Really? Biology?
Absolutely. Think about it. For hundreds of thousands of years, survival meant staying with the herd. If the herd ran from a rustling bush, you ran too, or you got eaten by a tiger.
Right, the safety in numbers instinct.
But in the crypto market, as we established earlier, the herd is exactly what the predator hunts. Our evolutionary instinct to follow the crowd leads us directly into those liquidation zones.
Wow. So we are fighting thousands of years of human programming.
We really are. Furthermore, our brains are wired to seek immediate dopamine rewards. We want the quick kill, the immediate caloric payoff. In trading, that biological drive translates directly into over-leveraging and taking massive, mathematically unjustifiable risks for a quick payout.
And professional trading is the exact opposite of that.
Completely. Waiting patiently for months for the $55,000 to $44,000 zone, refusing to trade in the chop, accepting small losses as mere data points, it's completely counterintuitive to our primate brains. Unless you actively rewire your psychology, your own biology will bankrupt you.
That is a chilling realization. Really puts it all in perspective.
It does.
So to summarize everything we've unpacked today from the Paradise team's update, surviving this specific market cycle isn't about making one lucky lottery ticket prediction.
No.
It's about understanding the raw mechanics of the exchange of hands and watching the weak hands fold. It's about tracking the natural breathing rhythm of the market, recognizing when the fuel is gone and gravity is about to take over.
Pulling that handbrake.
Exactly. And most importantly, it's about emotional discipline. It's about recognizing that whipsawing and consolidation are designed to destroy you and trusting a clinical, probability-based system over your own biological impulses.
It's the difference between hoping to survive a hurricane in a rowboat and building a submarine specifically designed to navigate the pressure.
I love that. Which leaves us with a final lingering thought for you to take away today.
Oh, this is a good one.
Simon mentioned that the market is a predator that tests your emotional discipline constantly. But consider the actual tools we use to access this market. Think about our phones. Think about the flashing bright green and red lights on the exchange interfaces. Think about the sudden vibrating push notifications designed to grab your immediate attention and spike your heart rate.
Pure dopamine.
If the market is a predator that feeds on emotional reactions and impulsive decisions, how much of our modern trading technology was intentionally designed to feed us directly to it? How much of it is built specifically to keep us in a constant state of biological reaction rather than logical probability?
Yeah, it makes you wonder.
It really does. Think about that the next time you open your portfolio app and you feel the urge to hold your breath underwater. Stay disciplined, trust the probabilities, and we'll see you on the next deep dive.